Did you know 68% of middle-aged Americans worry about their finances by age 50 and wonder if they can retire early? Follow the journey of a successful individual who overcame obstacles to build a profitable real estate and stock portfolio. In this video, I'll reveal 5 types of assets that will let you never work again, the common mistakes people make, and real-world tips to boost your income. At the end, I'll share the most powerful secret. Don't miss it. In a world where saving rates barely keep pace with inflation's relentless climb, many middle-aged Americans feel trapped watching their bank balances inch forward. The dream of money making money seems more like a cruel joke. Individual stock investing demands endless hours dissecting financial reports, chasing market headlines, and all too often falling into the hot stock trap. Sky-high gains one week, devastating crashes the next. Traditional mutual funds don't offer much relief either. Their hefty management fees quietly erode your real returns, and steep minimum investments shut out anyone who just wants to dip a toe before diving in. It's no wonder we stare at our portfolios wondering, how can we ease the pressure without sacrificing the chance to build lasting wealth? Enter ETFs, exchange-traded funds, our new best friend. Imagine capturing the broad strength of giant indexes like the S&P 500, think SPY, NASDAQ, QQQ, or high-dividend champions VYM, SDY, all in one simple stock-like trade. With hundreds or even thousands of companies bundled together, you instantly diversify. And thanks to automatic rebalancing, your fund gently shifts as the underlying index changes, shielding you from the heartbreak of overbetting on a single name. But the real magic? Ultra-low fees, often under 0.1% per year for giants like VOO or SPY, mean your returns stay yours, not the fund manager's. No big upfront capital required either. Start with just a few dozen dollars each month and embrace dollar-cost averaging. Funnel 3 to 5% of your income into 1 or 2 core ETFs on a regular schedule. Rather than devouring endless spreadsheets, you spend minutes each month rebalancing, freeing up time while harnessing the compounding engine to steadily create wealth. Choose your ETFs to match your heart's desire. If you crave pure growth, lean into large-cap staples like SPY or VO. If you yearn for reliable income, dividend yields above 2% from VYM or SDY can light up your cash flow. Crave a thematic edge? Tech-heavy QQQ, renewable energy, healthcare, or AI-focused funds let you ride tomorrow's waves today. A balanced portfolio might stack 70 to 80% in broad market ETFs and 20–30% in sector or dividend plays. Smart, simple, and risk-aware. Investing in ETFs isn't just about numbers, it's about peace of mind. No more sleepless nights tracking stock by stock. Instead, you build a rock-solid foundation for generational wealth step by calm step. Open your brokerage account, set up your recurring buys, and watch a simpler, more effective approach to wealth management transform your life. Today is the day to trade stress for strategy, so you can focus on what truly matters. Rental real estate can be a true money-printing machine for middle-aged Americans seeking a steady stream of passive cash flow. Picture this: you own a tangible asset, a house, an apartment, even an entire multi-unit building, and every month tenants hand you rent. Yes, the upfront capital can be steep, typically 20–30% down payment plus taxes, insurance, and repairs. But your goal isn't to flip the property. It's to collect that reliable, positive cash flow that lands in your pocket without selling a thing. To know if a property is worth it, investors lean on the cash-on-cash return. Imagine you buy a small condo for $150,000, put down $30,000, and set aside $5,000 for repairs and reserves, $35,000 total. If you rent it for $1,200 a month, that's $14,400 per year after expenses like property tax, maintenance, insurance, and management fees. Your cash-on-cash return is about 41%, $14,400 divided by $35,000.
In practice, a healthy target is 6 to 10% per year. Hitting 7% or more means you're comfortably covering costs and turning a profit. But that steady rent check is just the beginning. Over time, real estate often appreciates, adding icing on the cake. Still, don't bank on sky-high price gains alone. Markets ebb and flow. Focus first on stable rental demand by choosing neighborhoods near factories, schools, or administrative centers. Lower vacancy risk means uninterrupted cash flow. One pitfall to avoid is over-leveraging, borrowing more than 75% of a property's value. Heavy debt can balloon interest, taxes, and insurance if rates tick up. Many rookies learn the hard way that more debt equals more stress. Keep your loan-to-value under 70% and favor long-term fixed-rate mortgages. Even a 1% rate hike on a $150,000 loan can add over $60 a month in interest, enough to shave your profits dramatically. Don't forget the tax perks of real estate. Depreciation lets you deduct a chunk of the property's value each year, lowering taxable income. Operating costs, repairs, maintenance, insurance, interest are all deductible against rent income. And with a 1031 exchange, you can swap one property for another tax-free, reinvesting every penny into your next deal and supercharging long-term growth. Finally, expect your first 3 deals to be the toughest. You'll learn the legal checklists, property inspections, tenant screening, and cost controls. Once you've nailed the process on 2 or 3 properties, your system will hum, minimizing mistakes and maximizing cash flow. From there, simply scale up. More rentals mean more passive income, freeing you and your family from relying solely on your main job or retirement checks. Start building that real estate machine today and watch it transform your financial future.
For many middle-aged Americans, traditional investments like stocks or rental properties can feel limiting when you dream of true wealth. There's another path just as compelling: building a business of your own, where your ideas and expertise become the engine of unlimited upside. When you pour yourself into your own company, you're not just chasing returns. You're in full control, reinvesting profits to turbocharge growth and savoring the payoff, however big it gets. Starting your own venture usually means leaning into what you know, whether that's a cozy coffee shop chain, a specialty retail store, a health clinic, or a local repair service. Imagine launching a small organic grocery store with $50,000 to $100,000 in startup capital. Nail your brand promise, delight customers at every turn, and run the books ruthlessly tight, and you could see annual profits double or even triple your initial outlay. Then, by plowing those gains back into marketing, staff training, and new locations, you ignite a self-sustaining growth engine that builds real, lasting wealth. Alongside your own business, you might also explore startup equity crowdfunding, backing up-and-coming companies on platforms like WeFunder, Republic, or StartEngine. It's a way to diversify your portfolio, join the founder's journey, and share in massive upside if a startup takes off. Tech innovations, restaurant concepts, and fresh service ideas have raised hundreds of thousands, even millions in their very first rounds, proving that crowdfunding can be a powerful catalyst for generational wealth. But be mindful, about 80–90% of startups don't meet expectations. That's why you'd allocate only 5 to 10% of your total portfolio here, the amount you're truly comfortable risking. Do your homework, vet the founding team, dissect the product-market fit, and scrutinize the business plan. Spreading your bets across multiple startups further softens the blow of any single failure and boosts your chances of catching a big winner. Whether it's running your own company or backing emerging ventures, success demands strategic money management. In your business, monitor operating costs, cash flow, and return on equity religiously. In crowdfunding, track each startup's milestones, follow-on funding rounds, and valuation steps. Both paths offer far greater wealth-building potential than passive investing because you're hands-on in creating value. In the end, for a middle-aged American yearning to get rich, 2 frontiers stand out:
entrepreneurship, and startup crowdfunding. Launching your own enterprise lets you harness your experience, forge a brand, and reinvest profits to expand. Crowdfunding opens the door to outsized gains you simply can't find in traditional vehicles. Whichever route you choose, the keys are smart asset management, balancing risk and reward, and staying agile, ready to pivot when the market shifts.
In recent years, cryptocurrency has exploded onto the scene as an alternative asset class that's caught the eye of many middle-aged investors in America. Fueled by the rise of blockchain technology and a burning desire to shield wealth from relentless inflation, these digital tokens promise a fresh frontier. But to navigate this world wisely, you need more than curiosity. You need clarity on what crypto really is, the risks it carries, and how to allocate your capital sensibly. At its core, crypto dazzles with decentralization, radical transparency, and near-instant, low-fee transfers. It's the perfect tool for global transactions or storing value outside the traditional financial system. Bitcoin and Ethereum reign supreme, commanding the lion's share of market capitalization. Unlike stocks or real estate, their prices aren't backed by cash flows or physical assets, but by supply and demand, community faith, and real-world applications of the underlying tech. Yet that very Wild West nature brings earth-shaking volatility. Bitcoin can double in value within months and plummet by half in mere weeks. That's why experts classify crypto as speculative, thrilling, yes, but high risk. They advise capping your exposure at 5 to 10% of your total portfolio. It's a figure that lets you chase long-term upside without jeopardizing your financial foundation. One undeniable perk? Seamless international payments. Sending money overseas through traditional banks can cost a small fortune and take days. With Bitcoin or stablecoins like USDC, transfers often settle in seconds or minutes for virtually nothing and with no middleman. This efficiency is already reshaping remittances, cross-border e-commerce, and global financial services. But before you dive in, arm yourself against crypto's unique hazards. Regulatory uncertainty. Laws vary wildly across countries and are still being written. Security threats. A poorly secured digital wallet can mean irreversible losses. Market turbulence. Extreme price swings can rattle nerves and derail plans. To start strong, stick to licensed U.S. exchanges and invest only in coins with transparent technology and clear use cases. Steer clear of hyped-up altcoins built on rumor. Dollar-cost average your buys instead of going all in at once, cushioning yourself against gut-wrenching downturns. Viewed through the right lens, cryptocurrency becomes not a get-rich-quick scheme, but a strategic complement to a diversified portfolio. For middle-aged investors, it's a tool for wealth preservation and incremental growth, never a panacea. With a long-term mindset, prudent capital allocation, and a solid grasp of the blockchain beneath it all, you can transform crypto from a speculative gamble into a meaningful pillar of your financial strategy. Physical gold has long stood as an impenetrable fortress, preserving purchasing power and serving as a reliable asset management tool in any portfolio. For middle-aged Americans seeking to build real wealth, physical gold isn't a speculative play on price spikes. It's a solid shield against the worst economic and financial storms. First and foremost, tangible gold acts like insurance when currencies lose value to inflation or crisis. Unlike bank savings where your cash can stagnate or erode, gold retains its intrinsic worth even if the US dollar weakens. That peace of mind means you don't have to worry about how to hoard cash. Instead, you're safeguarding generational wealth for your children. Gold itself doesn't generate income the way dividends or rental checks do, but its stability creates a protective wall against financial upheaval. When stocks or real estate falter, gold often holds steady or even climbs, helping to balance overall portfolio risk. That defensive role makes it indispensable for anyone seeking sustainable wealth in midlife. Experts generally recommend allocating only 2 to 5% of your total assets to physical gold. Though modest, this slice of defense delivers outsized value.
If traditional markets swing wildly, your gold holdings help cushion the blow and preserve your capital. Depending on your risk tolerance and retirement timeline, you can adjust within that 2 to 5% range to suit your personal strategy. How you hold gold matters too. Instead of paper proxies like gold ETFs or gold mining stocks, consider buying internationally recognized gold bars or SJC coins from reputable dealers. That way, you own the asset outright without depending on any third party. For safety, store your gold in a personal safe or rent a bank safety deposit box. Buying gold regularly, say setting aside a small amount each month, lets you grow your position over time without obsessing over buy low or wait for a dip. Another advantage of physical gold is that you don't need to track its price every minute. Simply stick to your long-term plan and treat gold as your family's financial armor. Unlike stocks or ETFs that demand daily chart watching and market reports, gold stays quiet, yet always ready to defend your wealth when markets turn south. Ultimately, physical gold isn't just a savings vehicle, it's a cornerstone for lasting prosperity. By offloading worries about market bottoms, you free up mental bandwidth to pursue active income streams, whether boosting your primary salary, growing a business, or fine-tuning your stock and real estate holdings. Gold lays the foundation that lets you and your family face any storm with confidence and make flexible, effective money decisions. If you want to preserve and build enduring wealth, physical gold is non-negotiable. Keep it at 2 to 5% of your portfolio, buy regularly, favor bars or coins, and store them securely. That way, you not only maintain purchasing power in an inflationary world, but you also forge a steadfast defense for your financial future and the generations to come. Thank you sincerely for taking the time to watch this video on the 5 assets you can buy and never sell, helping you build sustainable wealth. I hope these investment tips and advice on avoiding common mistakes have provided you with real value. Please share your thoughts on these assets or any personal investment experiences you've tried. Don't forget to hit like, subscribe, and ring the bell so you won't miss the next video. See you again, and here's to achieving financial freedom soon with your investment portfolio.